Good afternoon. Welcome to the 12:30 Big Joel community call. Thank you for listening and hopping on. Wanted to let you know we are going to be, we've gotten a whole bunch of requests. So we're going to be putting most, if not all of these calls on our YouTube channel. So you could, if you want to go back in time and listen to any of the calls, there's a lot of good information in them. They will all be on there. Josh will be slowly loading them up on YouTube. Josh, is that the Big Joel Show? The YouTube, is that how they find it? The Big Joel Show?
Yep.
Okay. They're on Facebook. I know a lot of people are watching on Facebook Live or watch this on Facebook later, but they're all going to be on YouTube as well. So you'll be able to see them there. So just housekeeping up in the corner. We do have the chat. Clayton Collins is on today. Thank you, Clayton, with Housingwire, Chief Executive of Housingwire. So I'm sure he's got a couple of, if why not, 1, 2, 3 cool things to tell us. If he's citing any type of articles or links, he always puts them in the chat. So just know to look up there if you want to pull it down before the call ends. A little bit of housekeeping. Next week on the 16th, we do have another agent jumpstart 60-minute version. We got great reviews from that last time. You all are welcome to invite any agents, real estate agents to that you want comped on me. If you need the link, just send us an email, info@bigjoel or josh@bigjoel. We'll get you that link. Easy to either text or email over to your agent partners. We don't have another loan officer jumpstart starting anytime soon, but we do have a loan officer crush group. I know there are a couple people on here that have been asking about that. That starts next Friday as well. So welcome everybody. Clayton, welcome to the call. I know you weren't on last week. I know Sarah was. Anything interesting in the past week or anything that's on your mind?
I mean, outside of you apparently going viral last week, it sounds like you had a pretty a pretty good weekly call.
Yeah. People liked you either hated that message or loved it. It was only one way or the other.
Yeah. Well, we had a busy last week. We had our Housingwire Spring Summit last Thursday, which is our inaugural spring event for our HW Plus members. It was a really cool day with some great guests and speakers talking about mortgage technology, the wholesale market, the retail market, an economic preview with 4 top economists that will fuel some of the articles I'm going to share today. But really good day, and off to the races again this week.
Are you going to share with us some major, what I call aha highlights from that, or wows where your eyes got big and you said wow? Because that would be awesome.
The 2 biggest for me were, I moderated 2 sessions. One was an interview with Matt Ishbia from UWM, where he it was his first interview since dropping his bomb about kind of forcing brokers to choose between UWM and 2 of their other wholesale competitors, Fairway and Quicken, and he certainly doubled down on that message and sent a pretty strong with a pretty strong voice in our interview at Housingwire Spring Summit. So that was an interesting one to kind of have the front row view on, as he took an extremely hard line against some competitors.
Were people able to ask questions during that? By the way, I'm curious. Was there Q&A or no?
I didn't get to Q&A on that one. I was
okay.
I was a kid in a candy store asking him every question I could. So I didn't even open up the chat module for that one. I was focused on extracting the info that I was most interested
I mean,
in.
it's that stance is right up there with the Harry and Meghan interview. You know what I mean? In the mortgage world. I mean, is that, controversial? Yep. Everybody was talking about it. I was just curious if any audience people got to actually, ask a question. But did you hit him with anything hard? Like, what are you thinking? Like, why are you doing this? Or you?
Yeah, I mean, we got into how they actually plan to enforce it, and he talked about the data sources that they have to see every loan that brokers professionals send to different wholesalers. So they actually have a tracking and an enforcement mechanism. which I think was like a big question a lot of brokers initially had. Like, well, how are you going to kind of police this? Yeah, that was probably kind of the most like notable line of conversation as we got deeper there. We did go into some of their product plans and plans to shift in the purchase market. And I think that is notable, being the largest purchase lender in the country. Anything they do on product will likely impact product decisions that other lenders make. So they're coming back with jumbo in a big way on March 15th. So I'm kind of anticipating more wholesale and retail lenders to be more aggressive with their jumbo offerings as we go into this spring and summer purchase season, and potentially a little more aggressive on rates, as well as there's clearly some lenders that are going to be fighting each other tooth and nail at the expense of margin to win purchase business over the next 6 months.
Yeah, there's a lot of loan officers that have never seen the full on battle for revenue to not lay off, and what happens at the top of the house. And basically everyone, what happens is it's not even a memo. It's like a phone call. Drop your shorts, a quarter on this, 3/8 on that, a quarter on this, whatever it is, an eighth on that. And suddenly you're out there and you can't figure it out. You're like, wait, what is going on? Why is XYZ mortgage so sharp? But what most loan officers think is our rates suck. And, I always tell them, no, your rates don't suck. Your rates are totally fine. They're just dropping their shorts because they'd rather make $1 than $0.
Yeah, so
they don't want to have to lay off other people. Go ahead. Sorry, Clayton.
UWM finished 2019 operating at about a 100 basis point margin, and in their most recent filing in February, they were I think like 307 basis points on margin profile. So saw their margin increase by 200% year over year, which is driven by a lot of dynamics that happened in 2020, but ultimately means that they have there's room to be aggressive. Like there's room to get more aggressive on pricing. There's room to invest more in technology and people. And I'd recognize that most of their lenders aren't operating at that margin profile right now, but it does, like Bezos said famously a couple of decades ago, your margin is my opportunity. And I think that lenders will use their margin this year to win market share. And that's what we're really gonna have to watch closely.
Yeah, big and bad is going to win the initial skirmishes for sure. A lot of the smaller regional bankers, players are going to have a tough time. It's going to be okay. I mean, I've seen this 2 or 3 times in my career, but it's going to be a bloodbath. I mean, there'll be a lot of loan officers selling cars in September and October that were doing 10 loans a month and 9 of them are refis. And then the one purchase they had, they're screaming about rates, and their companies are going to be looking at them going, get out of my face, leave. Like, I don't even understand why you're lighting me up about this. Our rates are fine.
Yeah. So your quote there, big and bad. I mean, that's going to be thematic this year, and it's going to happen. It's going to happen a couple different ways. We're already seeing aggressive recruiting efforts go to build origination forces organically. People are going to fight for market share with rate and product that will come at the expense of profitability, or at least a portion of profitability. And third, which we expect to really see ramp up, especially if smaller lenders struggle a little bit with this big and bad thesis, is M&A. And in the second session I moderated in the afternoon, we had Mike Cagney on from Figure, and he shared some pretty like insightful view. Like with Figure, I don't know if everyone's familiar, but more like kind of home equity focused, and home equity and refi focused blockchain based lender. They've been investing a lot in blockchain in the mortgage space. We're one of the few. But like zero funnel on it for origination. So their view is they're going to go out and acquire originators as fast as they can in 2021 to take this technology they built in the back end and actually bring it to market. And so Mike dropped some details about exactly the characteristics of the lenders he hopes to acquire in 2021. and the cliff notes are the less tech, the better. He just wants reach, and then he'll layer the technology in. And I don't think he'll be the only lender that's invested in technology, not necessarily blockchain, but just like really good back-end tech that wants to do acquisitions this year. So I expect that M&A fight to be a really real headline in 2021.
It's going to be quite interesting dynamic too, because most of the big lenders are writing large checks for very good originators. And the whole M&A piece, since I started doing this, which has always been fascinating and interesting to watch, is this is a people business. I mean, maybe you're buying some leases and some old computers and some crap, but you're trying to buy people. And when people are getting offered massive checks to move around, it becomes a little harder to sell your business. You're trying to sell your people unless your people are in the game, unless they're stroking massive checks. So big and bad is important, because you can't just stroke a check to the owner or the owners for whatever, get them to move over, because that doesn't mean their people are moving. And in the past, their people would just move because this is a people business for lower numbers. But now they're seeing such massive offers put in front of them, they're not going to move the same way. It's just not going to be as quick. Oh yeah, you're going, I'm going with you. It's not going to be like that. I'm already seeing that. So who's ever making the purchases is going to have an even fatter checkbook than just fattening the owner of the company, because the players aren't going to play because they're already getting offered tons of cash. So they know what their market market worth is. I haven't seen that piece before ever. I haven't seen. I've had many conversations with a lot of my clients, about what they're getting offered, where their eyebrow is way up. They're thinking, maybe I should just take this, because the numbers are so huge. So I think it'll be fascinating to watch. There are obviously there have been some great acquisitions over the past couple of years, and there have been some really bad ones. And I got to tell you, I've gotten a couple of calls, Clayton, from top of the house on companies where they're interested in, they're asking me to sort of, sign an NDA and come in and look at some of the stuff to really go through and really see what they're buying. Like, what are they really buying? Are they buying, a bunch of refis hidden by, what are they really buying? What's going to be there in September or October when everything closes? I think it's going to be very easy to write a bad check, as far as I'm concerned.
Yeah, well, fortunately, there's some good precedents in market that kind of price these things appropriately, and mortgage banks have never traded at very high multiples because of that risk profile. So it's not completely uncharted territory on how to do deals and price them appropriately in this market. And I guess the third thing that came out of last Thursday is this increased focus across the board of all IMBs worth their salt of retaining servicing. And as we talk about valuation and building business value, especially as we potentially enter a rising rate environment, those MSRs are becoming increasingly valuable and a huge part of the strategy for every IMB that has the balance sheet to hold on to them, which I think is a great thing for originators, as it helps keep that relationship inside of the institution, increase probability of refi and future purchase business, long-term relationships, all the things we say happens, but the data shows otherwise. So seeing lenders start to retain servicing is a pretty good thing, I think, for the long-term viability, value, and sustainability of the IMB market. And data that came out of Inside Mortgage Finance yesterday showed a massive drop in servicing at the depository banks. So which I think is the other side of that, as IMBs start to retain more servicing and not sell the servicing rights. They're winning market share from the depository banks, and then they're not selling those servicing rights to the depositories with big servicing portfolios on the back end. So that's another new dynamic I think we'll have to watch in 2021, because I don't think the depositories are going to love seeing their MSRs dwindle to the levels they are dwindling to right now, which will be another competitive dynamic.
Yeah, it's interesting. It's this is as the world obviously has changed and is fascinating, interesting, and scary with the COVID stuff going on. In our world, it's going to be a very interesting ride over the next even 18 months. I think once everything settles down, we're going to have competitively low rates and just a steaming purchase market for a while. I personally think, based on demand, consumer demand. Anything else interesting that just everyone was talking about, or that just popped off the page or popped out yesterday?
Down like off the top of my head, the rundown from the top of my head from last Thursday. We had some great data released yesterday. I'll run through 4 items. Really quick, I've joked with y'all in the past that part of my charge here is proving Diana Olick wrong, and that the headlines you see on CNBC aren't always accurate of actual market dynamics. Here's one. Yesterday, the home purchase sentiment index came out from Fannie Mae, showed a drop of 1.2 percentage points from February. Mainstream press saw that as this massive drop in consumer confidence. But if you actually read the note from The Economist, you'll quickly see that this drop in confidence was entirely driven off of inventory concerns and the tiny rate bump we saw in the last few weeks. I know it doesn't feel tiny, but in historical context, it's tiny. Of the economists at Fannie and other institutions are projecting that sentiment index pops up pretty big in the coming months of spring, particularly driven around stabilization of rates and increased COVID vaccinations. COVID vaccinations are going to be the biggest driver of sentiment in 2021, and believe we're at like 15% of the nation that let me get that number right here. Doug Duncan at Fannie shared that I think he said 15% of people that are eligible for the Fannie or the vaccination have received it, and we'll see that continue to climb up. And they're modeling that into their sentiment modeling, which is cool to see. Spring purchase market. So we'll jump to the next economist on the list, Mike Fratantoni at the MBA. And seeing the numbers that purchase is projected to be really big in 2020, and the MBA keeps revising those numbers upward, particularly because of a couple reasons. Job market's improving faster than the economists projected. So the most recent projections on unemployment have unemployment dropping to 4.7% by the end of the year. It's currently at 6.2. That's getting us back into a relatively healthy range. But the flip side of that unemployment going down, the other counterbalance to an incredibly successful purchase market in 2021 is rates. And Freddie, Fannie, and MBA are still kind of projecting that rates level out around 3.5% in 2021. But recognize that if we tick closer to 4 or surpass 4, potential home buyers could be scared away from. But everything right now is in an incredibly successful purchase market in 2021.
Yeah, I'm going to agree with that. Are you, how many other things you got on that list? Because I'll take off right from that if you want, unless you're still going.
Sorry, Joel, did I cut out there?
You did a little bit, but I think most people knew exactly where you were going, and you didn't miss that one, many words.
Okay, cool. Sorry about that. Can you hear me?
No problem. Now? Absolutely. Yeah.
All right. And I talked about rates there a little bit. Logan on our team at Housingwire did a deep dive on rates this week, and part of his theme for the last year has been rates sub 3% are unsustainable, drives home prices up way too fast. And we know we're seeing that across the country. I've heard insane anecdotes this week, or like in parts of Arizona percent year over year, projected to be up 30% year over year by summer. I had a friend in Charlotte that just listed his house at 460 and went under contract at 610. Like there's some insane stuff happening in home valuations, and a stabilization of mortgage rates up at 3.5 or higher will be a really healthy dynamic for the long-term success of the origination market. If we stay where we are, inventory is going to get so bad, we're going to lose out on purchase opportunity because of inventory constraints. So the economists right now are all rooting for rates to continue ticking upward for long-term health, which is a dynamic we haven't seen in I don't know what's it been, Joel, since we saw a rising rate environment. Forever.
I mean, honestly, it's
Forever.
I would say that probably 80% of the loan officers on this call have never seen it in their whole career. I mean, they've never seen it really, what I call, turn and take off. Like they've never seen a turn and take off. Hi, Jen. They've never seen turn and take off. You know what I mean? So it's been quite a while, Clayton. I'd say it's at least 20 years. I mean, so for a real, I'm not talking about a bump. There'll be loan officers. Oh, Joel, I remember when it went up. I'm like, no. I'm talking 1.5% and not come back for 2 years. Yep. That kind of stuff. That's going up. That's turning and taking off. That's very different than the rates going up 0.5 or something.
Yeah. So I talked, I'm sure you all are doing this every day, but I talked to a friend off a cliff this week who was considering needs to sell his house and relocate for a job opportunity. He's going to turn down the opportunities. He's afraid of rising mortgage rates. And I sent him the 30-year chart from Freddie Mac showing mortgage rates over the last 30 years. He's like, okay, maybe I can get comfortable with my 3.4 and not, taking a job because of rising rates.
It's our job and our agent partners' jobs to really educate the consumer about what's going on, about their buying power, about what the kind of market they're buying in. It's a lot of pencil selling, Clayton, that in a lot of the pencil selling, went away almost with the advent of DU. I mean, there's loan officers on this call that if I just handed them a calculator and a pen and a napkin and made them do a pre-qual, they'd have a problem. They need their computer. And because of that, they're not great at pencil selling. And a lot of the agent aren't either. And that's a skill right now that you need, and your agent partners need. You need to be able to talk about future value of money, future value. You need to understand that so you can explain to someone, yeah, you might be paying a little more for your house, but look at the amount you're borrowing at. Look at what you sold your house for. I mean, it's pencil selling. It's literally a pen and a paper and showing them what's going on. And, the reality of it is somebody said to me, I was on a call, last week, those of you that were on this call, I went on probably a 10-minute rant about, qualifying 3/4 above the market, about making sure you have no unlocked loans in your pipeline, not locking a refi till it's docked, locked, and scheduled. You should not have anything dangling out on your floor that you pre-qualified at 2 3/4, where agents have people out on the market. And a loan officer's like, well, Joel, you don't understand. If the customer doesn't see that, 2 3/4, they're not going to be like, no. You're the one that doesn't understand. You're not selling it correctly. You're actually doing them a favor. Who wants to be out looking at houses pre-qualified at a number that's not even there? What agent who has no salary at all wants to work with someone for a month and find out they can't buy a house because a loan officer pre-qualified at a stupidly low rate, and now they can't get in the property. So, this is stuff that a lot of loan officers today have never had to deal with because basically the rates have been stable or going down for 20 years. So they've never really seen a hop, a bump, a really fast bump up. So, I mean, I tell everyone, you should be qualifying at 3/4 over. You should be doing it on a piece of paper. If the people are qualified, it's fine. You don't even have to tell them what you did. Just say, hey, you're good. They don't need to understand that they're good at 3/4 higher rate. If the rates happen to go up while they're looking, you'll tell them. The other thing about it, Clayton, that just drives me, completely like batty insane. Okay. Since Dodd-Frank, since 2009, 2010, loan officers do not get paid any more, any less based on how the loan is priced. That is not, we're not in charge of pricing. Okay. So sitting and watching the market every day and expounding on your incredible knowledge to your clients about the bond market is like the stupidest thing I've ever heard in my life. Okay. Because if you knew that, you'd be a bond trader and you'd probably hopefully be in Saint-Tropez right now on a private yacht partying like a rock star. Okay. You certainly wouldn't be doing loans if you knew what the rates were going to do. So, for you to pretend that you know what the rates are going to do to agents or borrowers is literal insanity. I mean, it's crazy town. One thing can happen. One tweet can move the market, send it gone, and you can't wait. And Clayton, last week I was talking about loan officers, and I'm sure some people were looking at the ground when I was saying this, that they're talking to a client. They're too scared to price it correctly, so they go low, okay? Then the loan's not locked, and they wait for the market to come back because they're too scared, okay? Basically, you're playing with your company's money. And when the market turns around and takes off on you, and you can't give the people what you told them, you will be fired. They will pay you what they have to pay you, and if you have too many loans, they will fire you. Most of you just haven't seen this before, but that's exactly what they're going to do. They have, per Dodd-Frank, they have to pay you your comp, they have to honor the rate to the client, and then you will be fired. You're gone, okay? There's no reason. If you need a concession, get it and lock the loan. If you have any loans in your pipeline that are floating that are not a builder deal or a short sale, you're doing it wrong, okay? You are literally doing it wrong. If you have pre-quals on your floor or on your what old people like me, and watch this, and see Jen Miklos used to do. Okay, we used to have stacks of files, manila files all over the place. Now they're virtually. Now you have this virtual stack. If you have people in that stack that you pre-qualified at like 2 and 5 ace, you need to like do something about that. You need to pull that out and rerun their numbers and make sure they're good. If they're not good, you need to tell your agent partners, yo, our boy's not good. You're gonna have to take it down. What do you mean? Blah, blah, blah. You have to be all over that. You have an agent partner write a contract, then you pick that file up and realize you pre-qualified them at some crazy rate that's not even available. And now either A, they're not qualified, or B, the borrower is losing it because you were a bad salesperson and did not explain to them what's going on. Everybody write these words down. These are my favorite words ever. In order to serve you better. That's what you start with. In order to serve you better, I'm going to run your numbers like this. In order to serve you better, agent partner, I'm going to pre-qualify your people like this. So you're protected if the market moves. You're still going to have a sale. Their jobs are hard enough anyway, writing multiple offers all over the place because inventory is so low. The last thing they want to do is actually get the house and have you go, oops, the people aren't qualified, or have the borrower literally go sideways because the payment you told them was $1,800 and now their payment's $1,920 and they're losing it, even though you said it was well, and now the agent has a problem and it's just a nightmare. Okay. And the borrower's looking at the agent and everyone's mad and they're mad. And the bottom line is they're mad over nothing. None of you did anything wrong. That's why when I hear loan officers pretend to a client or an agent that they know what the rates are doing, I want to strangle them. You're insane to be fronting like that. What our job is to originate the loan, package it, get it approved, and close it smoothly. Our job is not to create rates on the secondary market. That is not what we do. Okay? And by the way, we don't get paid any more or any less. Those of you that have been around for a while, we used to. It was called an overage and a shortage, okay? That all left in 2009. So there's no reason for you not to be looking down, taking the rate you have, quoting it, and locking it. Literally, there's no reason. And if you're out of the market, don't mini marketeer it yourself. Don't pray the market will come back with your company's money. Go to your boss and say, hey, I need a concession on this. Get the concession and lock it. Because I am telling you, you heard me last week. I'm saying it again because I got such a positive response for this conversation. I am telling you, if this market turns and doesn't come back, you're going to be in a world of hurt you've never seen before. And if you're busier, you're going to have yourself in such trouble. You will have an ulcer. You will be up all night and you'll just be getting yelled at for no reason because you literally can't control the market. You never could, okay? But you let it control you. You let the borrower control you, the agent control you, or the market control you. And really, it's not our job to do that. So every single person, you need to take a look at every pre-qual you have, any person you've talked to, see what you talked to them about, make sure it's close. If it's not close, you need to put your big girl or big boy pants on and call the borrower and tell them where things are. Because if it explodes when the contract gets agreed upon, that agent is not going to be happy with your program. Even if you did a perfect job, they're not going to be happy about it. The best loan officers in the country are way ahead of this. I'm telling you right now, if you're not pre-qualing 3/4 over the going rate, you're certifiably insane. If the rate is 3 1/4, you should be running numbers at 4. Okay, right on a piece of paper, right next to you, knowing your person's good. You don't have to tell them, oh, you're getting 4. We know they're going to freak out. You can run the numbers at 4. Know they're good at 4. They want to know what the prevailing rate is. You tell them what it is. If they had a house that minute and you locked it, no problem. But in order to serve them better, you're going to pre-qualify them at a higher payment, just in case the market goes the wrong way. Hopefully the market will go the right way and it'll be even significantly lower. That would be awesome. But I can't control that. We can't control that. To pretend you can and to be living in some, thing you're getting daily from somewhere about what the bond market's doing, I'm just telling you, as someone that's been around for a long time, weird things happen. And I think weirder things even happen now because there was no Twitter and there was no way for that information to get out that quick to move the market. But right now, one crazy tweet about something can move the market. And if it moves the market and the market doesn't come back for 45 days and you're playing around and you've got a contract, a 30-day contract, you got a big problem. Huge problem. And I'm telling you right now, you don't think your company will let you go over this? If you have 4 or 5 of those, they will. Okay? And they should, because you're playing with their money and you shouldn't be doing that. And if the rates aren't in line and you need to be somewhere, go to your boss and say, I need a concession. You don't want me playing around with this. We need to lock these people in. They're closing in 25 days. Okay, I'll just wait and see and check the market. Those of you that know exactly where I'm coming from right now, that is extremely stressful. By the way, it's not your job to have a piece of paper, okay, on your desk with everyone's name and their rate that you thought they were getting and you watching it all day and then calling them when it hits a certain thing. By the way, just so you know, that's nowhere in your job description. It's not one place in a loan officer's job description is that. It's nowhere. It's literally not. If you think it is, please text me or call me offline. I want to have a private conversation with you and explain to you how it's not. Okay? Could you have a strike price with someone that wants to refinance that's completely handed over all of their documents to you and have said when it gets here, I would like to refinance? Yeah, sure. But did you hear what I said? You have all their documents, not tire kickers, people that have stepped up and given you everything. Okay? You have basically an untriggered app because you don't have a property address, but you're ready to go. That is a different story, okay? What I'm worried about for everyone on this call is the mini marketeering of taking a deal low to get it and then praying the market comes back before it closes so you can lock it in correctly. That's what scares me for all of you, okay? So you want to talk to me offline on this? Great. I got so many phone calls from executives last week when they saw this. They're like, yeah, Joel, we'd like to take that 10-minute tape and send it to our whole company to literally what you just said, because everyone's doing what you said. And let me tell you, companies are not happy when they take haircuts like that. They are not happy, because if you're doing it, there's another 60 LOs doing it at the same time, depending on where you work. Okay. So this is important. I'm saying this for you. I know it sounds like a rant. I don't want any of you all to get caught. It sucks. It will give you an ulcer and it'll give you some gray hair, especially if you have a bunch of people that you're out on. I'm looking, some people are putting some stuff in the chat. I just want to check real quick. Okay. So by the way, Clayton has a bunch of links in the chat, by the way. About some of the stuff he was talking about. Thank you, Jonathan. Hi. Love the diatribe. Preach it, Joel. I'm really, I'm not trying to preach, but I am a passionate guy. And I hate seeing loan officers getting caught for no reason. Nothing makes me madder when a loan officer gets yelled at and they did their job right. They just didn't cover their butt. When they're getting in trouble for something that they shouldn't be getting in trouble. I don't know if anyone has any questions or any comments or anything for Clayton. I've been keeping these calls to about 30 minutes because I think that's a really good time. Clayton, any final words after listening to that rant?
No, I'm just ready to go lock some loans. Even though I'm not an originator, I'm ready to go.
Lock everything. Remember, everybody, right in your face for refis, it should say doc, lock, and schedule. Unscheduled refis in your pipe make your ops people hate your guts. Put them on the phone right now. They will all be clapping and giving me thumbs up right now. Okay? Refis in your pipe that aren't scheduled make your ops people hate you. Okay? They should be scheduled just like a purchase so they can push to the date, get them closed on time, have the correct payoff, and make everybody happy. Refis are 10 times as complicated as a purchase. Your ops people are explaining way more to the client on a refi, especially when that date moves. So you want to do them a favor? You lock that thing for 60 days, schedule it for 55 out, and just forget about it. Doc, lock, schedule. Okay? Everyone, thank you so much. I'm hearing more and more people getting vaccinated. I just want everyone to know you're about to see some stuff that you haven't seen before as people start crawling out of their homes and the rates are extremely low and people still want to move bad because they're freaked out this is going to happen again in the fall and no one wants to still be in their house. This will be the epically massive purchase market. You've heard about a month ago, it was Clayton, Sarah once, and then Clayton, about comparing the volume to the top of the market in 06, literally right in the middle of the 80-20 LIDOC bonanza, where literally you blew in a mirror like this and you got a loan. I mean, it was insane. Okay. The volume is higher. It was higher than that. And everyone has to pre-qualify. So just to give you an example of the demand. All right. And I personally feel you're going to start seeing inventory. People are going to start listing their houses. Watch. It's coming. It's coming right now. Okay. As people can get out. So everybody be safe out there. And hopefully some of y'all are starting to get vaccinated and be safe. And I will talk to everybody next Tuesday. Clayton, thank you so much as usual. We always appreciate your time. See you all later.